Hi everyone, I am Abhishek Sharma, Director in Transaction Tax and Regulatory Division in Diwan P. N. Chopra Company. And today I have an important question for all of you. Are you guys thinking about selling or acquiring the shares of an unlisted entity at a price which is below the tax FMV? You need to rethink the same due to the income tax implications. These income tax implications will impact both seller and buyer. Generally, in case of transactions related to transfer of share, the sales consideration is based on the commercial terms agreed between the seller and the buyer. However, we should keep in mind income tax deeming section prescribing the fair market value as deemed sales consideration. These sections are deeming sections and are applicable to both buyers as well as sellers. These are anti-abuse provisions which are introduced in order to prevent the practice of receiving the sum of money or the prescribed property without considerations or for inadequate consideration. Tax implications in the hands of the seller. Let's first start with the Section 50CA of the Income Tax Act, which applies to the seller. Section 50CA applies to the unquoted shares which are not traded in the stock exchange and are sold for less than tax FMV. Under Section 50CA, the seller is taxed based on the fair market value of the shares, not on the actual sales consideration. The sale price does not matter to the tax department, they keep the fair market value as the full value of consideration. This means that if the transaction value is less than the fair market value, the difference will be taxable in the hands of the seller as capital gains. Let's understand this with the help of an example. Suppose sales consideration agreed between buyer and seller is 50 lakh and the tax FMV of the same is 1 crore. For income tax purposes under Section 50CA, FMV of such shares, that is 1 crore, will be treated as sales consideration and the seller will be taxed on 1 crore even though he only received 50 lakh. The difference of 50 lakh will be taxed in his hands as in capital gains. Now let's discuss the tax implications in the hands of the buyer. In case of the buyer, for purchase of unquoted shares, Section 56(2)(10) of the income tax comes into the play. When he purchases the shares at a consideration which is below than tax FMV and the difference between the actual sales consideration and the tax FMV is more than 50,000, such difference between tax FMV and the actual sales consideration shall be taxable as income from other source in the hands of the buyer. Now let's summarize these tax implications in the hands of the seller and the buyer in the same transaction with the help of some example, where sales consideration is 50 lakh and the tax FMV is 1 crore. Now the implications in the hands of the seller will need to pay additional tax on the difference amount which is 50 lakh as capital gains under Section 50CA even though he only received 50 lakhs. In the hands of the buyer will need to pay additional tax on the difference of 50 lakh as income from other sources even though he is paying only 50 lakhs. Now what is tax FMV? Tax FMV will be determined as per Rule 11 UA of Income Tax Rules 1962 on the valuation date. Rule 11 UA prescribes the methodology for fair market value of unquoted shares as below. These fair market value for the unquoted shares will need to be computed by taking book value of all assets and liabilities other than certain specified assets. These certain specified assets are shares, securities, immovable property, paintings, archaeological collections, etc. These certain specified assets to be valued at fair market value instead of book value. So now, as discussed in this video, selling shares below the tax FMV can lead to serious tax complications for both buyer and seller, as it leads to double taxation, where buyer and seller both are paying taxes on notional income in the same transaction. Hence, stay informed and take your decisions wisely.